Spotting good stocks early is about recognizing patterns before the crowd reacts. Investors who succeed usually focus on signals others ignore. The stock market often moves ahead of public attention. Learning to read early signals gives you a major advantage. Good stocks often show hidden strength before price rises. These signs can appear in financial data, trends, or behavior. The key is to look beyond hype and headlines. Many beginners chase stocks after they will already rise. Professionals aim to enter before the big move starts. This requires patience and observation skills. One important skill is understanding business fundamentals. Strong companies grow consistently over time. Growth often starts quietly before becoming obvious. Revenue trends can reveal early strength. Earnings improvements are another key indicator. A company expanding its market share is worth watching. Innovation often drives early stock potential. New products can signal future growth. Leadership quality also matters a lot. Strong management teams make better long-term decisions. Investors should study how a company competes. Competitive advantage is a powerful early signal. Companies with unique products often outperform. Weak competitors can help strong companies grow faster. Industry trends also influence stock potential. Growing industries create more opportunities. Early investors often identify rising sectors first. Technology sectors often produce fast growth stocks. Healthcare innovation also creates strong performers. Consumer demand shifts can reveal hidden winners. Watching customer behavior is very useful. If users are increasing rapidly, the stock may rise. Social media trends can also hint at popularity. Word of mouth can drive early growth. Price movements sometimes reflect early insider confidence. Volume changes can indicate rising interest. Sudden spikes in trading activity are important signals. Institutional buying often comes before price increases. Smart money usually moves first. Retail investors often follow later. Understanding market cycles is essential. Every stock moves through phases of growth and decline. Early phase identification is a key skill. Accumulation phases often come before breakouts. Many good stocks look boring before they rise. Low attention periods can offer the best entry points. Emotional discipline is necessary for success. Fear and greed often distort judgment. Good investors stay calm during uncertainty. Research is more important than rumors. Data-driven decisions reduce risk. Consistency in analysis improves results. Learning from mistakes builds experience. Patience is a major advantage in investing. Spotting good stocks early is a skill developed over time. Financial statements are the foundation of stock analysis. They reveal the true health of a company. Revenue shows how much money a company earns. Rising revenue often signals growing demand. Profit margins show efficiency in operations. Higher margins usually indicate strong management. Net income shows final profitability. Consistent profit growth is a positive sign. Cash flow is even more important than profit. Strong cash flow supports long-term stability. Debt levels must be carefully examined. High debt can increase financial risk. Low debt companies are generally safer. Balance sheets reveal financial strength. Assets should exceed liabilities in healthy firms. Return on equity shows how well money is used. Higher ROE indicates efficient management. Earnings per share helps compare companies. Rising EPS is a strong growth indicator. Consistency in earnings matters more than one-time spikes. Quarterly results can reveal early momentum. Sudden earnings growth often attracts investors. Guidance from companies can signal future performance. Positive outlooks often lead to price increases. Analysts also influence market expectations. Upgrades can trigger buying interest. Downgrades may indicate weakness. Comparing competitors helps identify leaders. Industry averages provide useful benchmarks. A strong company often beats industry growth. Cost control is a sign of efficiency. Companies that manage expenses well perform better. Innovation and cost reduction improves margins. Scaling business models often increase profits. Subscription models provide steady revenue. Recurring income is highly valuable. Diversified revenue streams reduce risk. Overdependence on one product is risky. Expansion into new markets signals growth. International presence increases opportunity. Strong branding supports pricing power. Pricing power allows higher profits. Customer loyalty improves stability. Retention rates show business strength. High churn can indicate problems. Financial transparency builds investor trust. Hidden risk may appear in reports. Reading footnotes is often important. Accounting practices practices can affect results. Conservative accounting is more reliable. Aggressive accounting may hide risks. Comparing multiple years gives better insight. Trends are more important than single numbers. Strong fundamentals attract long-term investors. Financial analysis helps identify future winners early. Market sentiment plays a big role in stock movement. It reflects how investors feel about a stock. Positive sentiment can drive prices higher. Negative sentiment can push prices down. News often influences investor behavior. Breaking news can change stock direction quickly. Insider trading activity is an important signal. Executives buying shares often shows confidence. Heavy insider selling may signal caution. Institutional investors move large amounts of money. Their actions often precede big price changes. Hedge funds are closely watched by analysts. Their positions can indicate strong opportunities. Social media trends can impact stock interest. Viral attention can increase demand quickly. However, hype is not always sustainable. Distinguishing hype from real value is essential. Earnings surprises affect sentiment strongly. Positive surprises often lead to rallies. Negative surprises can trigger sharp drops. Analyst reports shape investor expectations. Upward revisions attract new buyers. Downgrades can reduce confidence. Market rumors should be treated carefully. Verified information is always more reliable. Trading volume reflects interest levels. Rising volume often confirms momentum. Low volume may indicate weak interest. Market fear can create buying opportunities. Panic selling often leads to undervaluation. Contrarian investors buy when others sell. Overconfidence can create market bubbles. Emotional extremes are common in markets. Smart investors remain neutral. News cycles move stock prices temporarily. Long-term value is more important than headlines. Economic indicators influence sentiment. Interest rates affect stock valuations. Inflation impacts company earnings. Global events can shift markets quickly. Political stability supports investor confidence. Uncertainty increases volatility. Currency fluctuations affect global companies. Commodity prices influence many industries. Oil prices affect transportation stocks. Technology news drives tech stocks. Healthcare news impacts medical companies. Legal issues can damage stock reputation. Regulatory changes affect industries. Timing is important in reacting to news. Early reaction can lead to better gains. Delayed response often reduces profit. Sentiment analysis improves decision making. Combining data with sentiment is powerful. Understanding sentiment helps spot stocks early. Technical analysis helps identify price patterns. Charts show historical price movement. Trends indicate overall direction of a stock. Uptrends show rising prices over time. Downtrends show falling prices. Sideways movement shows consolidation. Breakouts often signal strong moves ahead. Support levels act as price floors. Resistance levels act as price ceilings. Breaking resistance can trigger rallies. Moving average smooth price data. Short-term averages show recent trends. Long-term averages show overall direction. Crossovers can signal buying opportunities. Volume confirms price movements. High volume strengthens trends. Low volume weakens signals. Relative strength shows stock performance. Strong relative strength indicates leadership. Weak stocks often lag behind the market. Momentum indicators track speed of movement. Strong momentum often continues briefly. Overbought conditions may signal reversal. Oversold conditions may indicate rebound. Candlestick patterns show market psychology. Green candles indicate buying pressure. Red candles indicate selling pressure. Reversal patterns suggest trend changes. Continuation patterns suggest trend persistence. Gaps in price show strong interest. Gap ups often signal bullish sentiment. Gap downs often show bearish sentiment. Chart patterns repeat over time. Head and shoulders indicate reversals. Double tops signal potential declines. Double bottoms suggest potential rises. Flags indicate short consolidation. Pennants show continuation patterns. Volume spikes often precede breakouts. False breakouts can trap investors. Confirmation reduces trading risk. Multiple indicators improve accuracy. No single indicator is perfect. Combining tools increases reliability. Discipline is essential in trading. Emotional trading leads to mistakes. Entry timing affects profitability. Exit timing is equally important. Stop losses protect against losses. Risk management is crucial. Position sizing reduces exposure. Diversification lowers risk. Technical analysis works best with fundamentals. Practice improves chart reading skills. Technical signals help spot early opportunities.